What's up, everyone? It's Caddy with MoneyVest. So today we are going to be talking about Bank of America's Michael Hartnett's analysis of 2024 and what the rate cuts might look like going into this year, and also what sectors and what specific areas in the market could benefit from the Federal Reserve's pivot, because this is going to be the first time since 2020 where the market's expecting the Federal Reserve's rate cuts, to be more than the potential hikes. So hope you all enjoy this video and find it helpful. If you do, make sure that you drop a like, and of course don't forget to subscribe to the channel. That's all I'm asking in return. The first week of the month is the best time to join if you want to take advantage of our MoneyVest Discord and our Patreon. All the links are going to be down below with that 16% annual discount that's available, and of course you get access to all the 40 plus members only private videos, Excel to all the Excel spreadsheets, of course our watch list and our fair values, and all the Discord channels including trade alerts, buy and sell alerts, options alerts. Everything is going to be included as well. So central banks around the world will cut rates this year, says Bank of America's Michael Hartnett, and there are only a few times in history where a pivot took place in an economy like this. What they mean by that economy like this is when the unemployment rate is still so low, inflation, core inflation specifically, is still a little bit more elevated at close to 4%, and this is a very unusual time for the Federal Reserve to be cutting rates. And why is it unusual, right? Why is it that this has happened only a very few times? That's because, as I mentioned before, the Federal Reserve always needs a reason to cut rates. They're not going to cut rates just because. They're going to cut rates because they're trying to fix something. They're trying to solve a certain crisis, solve a recession, solve a deflation, solve something that they're going to want to fix by lowering interest rates. And right now, we haven't seen anything yet. So according to Bank of America, Jerome Powell are hardly alone. A new note authored by Michael Hartnett, head of portfolio strategy at Bank of America, expectations that there will be a whopping 152 rate cuts made by central banks around the world in 2024. That's the first time since 2020 that cuts would outnumber the number of hikes. So this right here is basically what we are witnessing. Of course, 2021, 2022, we saw a significant amount of cuts because of the recession, because of the pandemic, and stimulating that growth in the economy. And this right here is going to be since 2020. We are expected to see more cuts than hikes all over the world and of course across all central banks. This is not just Jerome Powell and the Federal Reserve. So that again is going to essentially mean a huge pivot from the central bank perspective. Now, while the sheer number of cuts that will hit economies around the globe is peculiar in and of itself, what Hartnett finds really interesting is the timing of these cuts as well. Only 5 occasions in the past 90 years, the Federal Reserve cuts rates when core CPI now over 4% higher than unemployment of 3.7. So only 5 times. Can you believe that? Only 5 occasions in the last 90 years, the Federal Reserve has cut rates when inflation, core inflation more specifically, was over 4%. And unemployment was 3.7. That's exactly what I mentioned earlier, is that this is a very unusual situation in a sense, because the Federal Reserve is cutting, or is expected to cut rates on the back of nothing. Literally nothing. Inflation is still elevated, and we've of course got unemployment that's still very low. So we've got a very resilient jobs market, and economy continues to grow. It is still a very resilient economy. So why would the Federal Reserve be interested in cutting interest rates? It's only because of markets' expectation and the overall trend of inflation as well. So markets expecting 7 to 8 rate cuts in 2024, and inflation's been trending down. So the Federal Reserve and, of course, monetary policy, they've been getting a lot of pressure from all over the world, and, of course, from a lot of political pressure as well to maybe lower interest rates, considering how significantly inflation's been coming down. But what you'll notice here on this chart is every single time that instance happened, so when core CPI was above the unemployment rate and the Federal Reserve started cutting interest rates, this was October 1942, this was October 1969, August 1974, May and July of 1980, 1981 respectively, and this right here is going to be December 23 and going into 2024 as well. So all these 4 instances kind of led to some pretty dramatic events. So those previous 5 instances were usually precipitated by dramatic events such as World War II in the case of 1942 rate cut, or by recession, or was the case in 1969, 74, 80, and 81. This time, however, is different. The four most dangerous words in the stock market this time is different, folks. This time is never different. Not saying that this is actually going to lead to a pretty significant recession or pullback in economic growth and skyrocketing unemployment. No, but we have to keep our eyes and ears open. We have to be alert because it's kind of odd that, yes, this time in 2024 will be different. The Federal Reserve will have the liberty to cut rates while also having a soft landing, and everything's going to be just fine. It's going to be sunshine and rainbows, because it's never is. It's always something that breaks, which leads the Federal Reserve to cut rates, and as a result, the market does drop and then starts to rally, of course, during that recovery after the rates have already gone down. But it always it happens on the back of the Federal Reserve kind of fixing something, solving something because something's broken. Hartnett pointed out that many on Wall Street consider the Fed's pivot to easier monetary policy in 2019 to be the closest approximation to today's economic scenario, mostly by dint of being the closest chronologically. But Hartnett believes that the pivot in 1975 is a better example of what happens when the Federal Reserve cuts interest rates in an economy like today's. After all, back then, the Federal Reserve was pivoting after a hard landing, all while contending with entrenched inflation in 70s World War, oil shocks, fiscal excess, and industrial unrest as well. And this right here is the 1960s and 1970s, and how, of course, the federal funds rate was getting cut. The Federal Reserve was easing at the time. The markets also dropped because there was a lot of sort of crises, and inflation once again reaccelerated. So the Federal Reserve once again hiked. So Federal Reserve was tightening at the time. Then they started easing again. Then they started tightening again. So there was a lot of back and forth in that 11, 12-year period because the Federal Reserve themselves were very confused with Paul Volcker and, of course, inflation running rampant at such high levels. And as a result, there was a lot of back and forth because every time they lowered interest rates, inflation accelerated back up. So that's one of the things that I believe Jerome Powell and the Federal Reserve do not want to repeat. They don't want to repeat this mistake of lowering interest rates too much too fast, only to see inflation reaccelerate back higher and basically water all the hard work that they've done so far. It's going to go to waste if inflation goes back up again. So that's one of the things that they have to make sure that does not happen. That's why they're going to go very, very steadily, and markets expectations are very, very high. Kid you not, 7 to 8 rate cuts is a pretty significant number, whereas the Federal Reserve is only pricing in 3, maybe 4, and even those are going to be subject to where inflation ends up being. Now, those issues sound an awful lot what the Federal Reserve is facing today, and if history repeats itself, then 3 investments in particular should benefit from the Federal Reserve pivot: REITs, small caps, and value. REITs, highly recommended in my personal opinion. I'm buying a Realty Income Corp. That's ticker symbol O. I will continue to buy them. Small cap stocks, yes, because they're also have underperformed in 2023, and I do believe they're going to actually do really well in 2024. And value stocks, just because it's going to be a little bit more defensive play, and defensive in the sense that the Federal Reserve is going to be cutting rates because there's a problem to fix, and the problem could be anything, could be a crisis, recession, inflation, deflation, whatever it is, but that is going to lead to markets being a little bit more defensive. Of course, where volatility is high, markets are going to see some type of a pullback or correction. That's exactly why I think value stocks could benefit. Being in a defensive sort of positioning could benefit in that environment as well. So that's the entire analysis from Michael Hartnett and Bank of America. Let me know your thoughts down in the comment section below. But of course, S&P and the NASDAQ, they're both within striking distance of an all-time high. Futures are slightly green, somewhat flat to slightly down for the NASDAQ. But S&P, of course, 4,800 is going to be that resistance with a support level at 47.27, all the way down to 4,600 for the S&P as well. Of course, we're a bit more overbought, so I'm going to be very, very cautious considering where we are at the moment. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Of course, do check out our Discord and our Patreon link down below. 16% annual discount. I've extended that sale for a few more days for New Year's so that you can access all the members-only private videos, all the trade alerts, buy and sell alerts, options alerts, and of course, access to all the spreadsheets included there as well. And happy investing. I'll see you all in the next video.